Hello people, this is Dr. Wang here recording. I hope you guys are doing okay. This video clip will cover our textbook case, case 24, Victoria Chemicals. It looks like a chemical firm existed in Britain. The thing is, when I do my research, it's actually not a company that really existed. But this case was widely used in many textbooks. I also found it in the Harvard Business Study case. So it has a lot of potential meanings in the topic of capital budgeting. And in this project, we will cover the capital budgeting. And what's new about this project is that we are comparing two lines of cash flows. So the company is going to adopt a new machine, and the old machine will be abandoned. The thing is, if you are doing such replacement, you have to account for the cash flow the old machine would generate, because you are not getting the old cash flow if you switch to the new cash flow. So the old cash flow will be counted as opportunity cost, and it is only the incremental cash flow, which is new minus old, that matters. Okay, we cannot do the capital budgeting separately for the new project only, because the old project also give us some losses. When we abandoning the old project, it give us some losses. And you are going to apply Excel practice in this spreadsheet. So this is gonna be what it looks like when you are done. And this comes from the page 356. So it's the last table offered by the textbook for this case. This is where you get started. It's right here. So you have all the data showed up on this top panel. And here is the stuff you need to work on. And I have plugged in the annual depreciation right here. It looks like a double declining depreciation method. And I think it would be nice for me to put it here to save you some troubles. And at the end of the project, you are going to calculate the project NPV, IRR, and also payback period. All right, so you are going to submit this homework through Canvas, and you have several days to have it finished. So this is the Word document that provides the instruction. So basically, it's telling you you're gonna do the textbook case, and you're gonna replicate all the numbers from the page. So what's going on here is we have this UK company, fictitiously speaking, and they want to improve their financials, of course, and the textbook tells that if they don't, then their share value would drop. So if the share value is dropping, it's definitely not a good news for the shareholders, especially when this company, Victoria Chemicals, are facing hostile takeover. So that means if the share is too cheap, then there will be some guy coming over and buy the company, and then do the restructure and lay off a lot of existing managers, and maybe hurt the interest of the existing shareholders. So they don't want that to happen. So they have to find some ways to improve the performance by adopting a new machine. From the case name, you can see that they are producing chemicals. Okay, so let's get started. So what you see here, the information is telling you that this company has an annual output which is a pretty consistent at 250,000 tons of chemicals. And you also have the output gain, which is 7%. The price per ton is measured in British pounds. It's 675 pounds. The inflation 0%, which is good for us. We don't have to deal with the price change from year to year. You have a gross margin. So we have countlessly done this gross margin calculation. And you also have the old gross margin, which keeps at 11.5%. All right, so you have two gross margin, the new ones and the old ones. The new ones is definitely higher than the old ones. That's basically the reason for us to adopting it. And also, things are getting better. If it happens in the first 5 years, then there will be a 1.25% increase in gross margin. But if you wait until the 6th year to the 10th year, the gross margin improvement will be only 0.75%. And then after 10 years, then the gross profit margin will improve only by 0%. So from year 11 to year 15, the gross profit margin increase by 0% will be 12.5%. But from year 1 to year 5, it will be 12.5 plus this increment, which is 1.25. So that's going to give us 13.75% and so on. Okay, I forgot to say what this means. So 7% basically means if you adopt the new machine, then the new machine has higher productivity, then the annual output will jump by 7% at a yearly basis. So you also have a discount rate. It looks like it is the cost of capital, which the company will use it to discount the free cash flows. The tax rate is 30%. And you also have an investment outlay. That's 12 million pounds. The 12 million pounds basically is telling us that's the initial investment for buying the new machine. And the salvage value will be 0. So if you get rid of the old machine, you will get nothing. And also, after 15 years from now on, you will wear out the new machine, and still you get a 0 salvage value. The working inventory as a part of the as percent of a cost of good, it's a 3%, and you also have some downtime for construction, and which would give you some suffering on the sales, but I have incorporated that here for you. And also you have the engineering cost, and you also have overhead cost. The overhead basically is a fixed expenses. That's 3.5% of your investment outlay. And there's also shares outstanding. So based on the free cash flow, you can calculate the NPV. So NPV basically is the value added to the firm's market value. And based on the market value, you can get a fair price for the stock price per share. Okay, alrighty. So right here, we have a layout, the year number. So that's the project year from 0 to 15. And also you have the calendar year number from basically right now it's 2007. The year 1 is 2008. So what will be your new outputs? So as I said, the new output will be this $250,000 constant output plus 7% increase. So let's just use that number. So 250,000 times 1 plus 7% increase. So that's the new machine's productivity. And then in the next year, it will be the same productivity. So the production level will be the same. And then I just drag it all the way. And I just need to keep checking my number from the textbook to make sure everything is all right. Once again, the key, it's not exactly the key, it's the number output is on page 356. And again, if I grade your assignment, I will grade based on the formulas, not just the numbers. Okay, so right here, you have a loss of output. So basically, when you set up the new machine, you need to spend time to do the installation, and before that shipment and so on. So you will waste some time, and that's going to be the loss of output for the new machine being set up for not being at work. All right, so the new sales will depend on your output and the price per unit. Okay, for the inventory, it is a little bit touchy. Because what really are doing here are cash flows, whereas inventory is a storage concept. Okay, so only the change of inventory that would affect our cash flows. If inventory this year is 4.9, the next year is 4.9. If it does not change, then there's a zero cash flows based on that. Okay, so for the first year, your inventory is negative 0.39. That means you have liquidated some of the inventory, and that's gonna be some cash flow for you. You should put a positive 0.39 in number here. However, you should compare that from the year before. So from the year before, your inventory was quite constant. There's no change of inventory. But here you have some deduction inventory that caused you to receive some cash. So you need to put the previous level and then minus the current year's change of inventory. All right, so that's going to be your number for the first year. And then if you compare the second year, you will see that your inventory recouped. Not only this 0.39 got recovered, but also inventory increased by 0.19. So your inventory actually jumped by the total of these two absolute numbers. So I just keep dragging it. So this will give me a negative 0.58. So that means my inventory was pretty small at year one, but at year two, it got increased. So this is how much the increase of inventory, and I'm spending this much of cash in there. And then in the next year, there's no cash being spent for the change of inventory because the inventory just keep at 0.19. You see, if you look at your new inventory, it is 4.67 all the way. So there's no cash flow generated from the change of inventory. And even you consider the opportunity cost for abandoning the old project could require this much of inventory, which also does not incur any cash flows. The difference between these two is 0.19, and so that's the incremental benefit or cost for this new project, and this inventory does not really change, so there's no cash flow effect. And then I just keep dragging. You see your cost of goods sold for the new project keep changing due to the variable gross margin. Then your new inventory would change, and so the cash flows from the change inventory would be different in some years. Okay, in which years it will be the first year your gross profit margin change. Recall that on the top of page you have this different increment of gross profit margin, and that gonna lead different level of cost of goods sold, different level of inventory required to maintain those cost of goods sold. And that basically would happen in some years, in year 1, in year 6, and also in year 11. Okay, now it's time to consolidate. So I'm going to add the first is capital expenditure. To calculate the new sales, you need to get the total amount of output for this year. The thing is, I mentioned we lost some output because of the installation of the machine. So we have to incorporate that. So the units of output should be the two numbers put together. You can add them both, or just to use the sum formula. So, and then I need to multiply the price, which is 675. And then since this is measured in millions, I'm going to divide the number by 1 million. Okay, make sure 6 zeros are put in there. So you will get 157.99, and this will be in British pound. Alrighty, and if you just drag it, then you will see that I have not locked anything. So basically, I need to lock the price. Okay, hit F4, and then I drag it. I mentioned earlier that the inflation is 0%, and we still need to give some thought about that. So I want you guys to incorporate 1 plus the inflation rate and make sure inflation is locked in your next formula. Although it's 0% inflation, we still need to have this maybe later on in the capital budgeting, the managers may change the inflation rate due to some macroeconomic condition. Who knows? Okay, but we still need to incorporate that number. Okay, so if you drag it, and you will see these are all there. Okay, the price is 675, and you have 0% inflation, and you have your output, and this time you don't have a loss of output, and then you just drag it all the way. Okay, to year 15. And then you have a new cost of goods sold. The new cost of goods sold is not really in the textbook. I just put in here because later on we need that to calculate the inventory. Okay, do you see that? Okay, the working inventory of the project. So what I need to do here is I will calculate the new gross margin. So you will see that it will be 12.15%, 50%. Have it locked. The thing is you need to add certain numbers for the first 5 years. So let me add this 1.25% and make sure it's locked. And this improvement in gross margin due to energy savings is 1.25%. So that basically will incur less cost of goods sold because that cost of goods sold is sales minus the variable cost. This is it's a variable cost, and then when you have a less cost of goods sold, you will have a more gross profit. And then this 1.25% lasts for the first 5 years, and then in the second 5 years, from year 6 to year 10, you are going to use the base gross margin, lock it, and then you add the second increment number, make sure it's locked as well, and then you drag it to year 10. And then after that, it will be this 12.5% locked plus 0% increment locked. And then you just keep dragging it. Okay, so based on the gross profit margin, you can get the gross profit. So you will use your new sales multiplied by this gross profit margin. So that's your gross profit, and then drag it all the way. And for the new cost of goods sold, actually this number should come first, but in the capital budgeting, we just go with the gross profit margin, and then we solve backward. So after you get this gross profit, you will use the sales minus the profit, and that difference is the cost of goods sold, aka variable cost. Alrighty, so this line again is not providing the textbook. I just put in there because that's going to make my life easier when I calculate the inventory. Okay, for the old output, that's going to be quite simpler. You will put the output level, and this number does not change from year to year. And then the old sales, it will be the price. Okay, make sure it's locked, multiplied by this output. Oh, that's a lot number. Okay, I did not quite switch the units to millions. Okay, then divided by 1 million. You see I'm looking at this formula bar. Okay, nonetheless, I want you guys to see it better, but zoom out. Okay, and then your gross profit of the old machine is 11.5%. So I will use my sales multiplied by 11.5%. Okay, and make sure this gross profit margin is locked. And my cost of goods sold will be the difference between sales and gross profit. Okay, so you see, I can just oops, it's a sales. minus the gross profit. I can just drag it all the way, but I have not incorporated the inflation yet. So for the sales, I will incorporate this 1 plus the inflation number, which is 0%. Okay, put it in there for formality. Okay, it does not change, and the output does not change. The gross profit margin per se does not change. So that basically make my gross profit doesn't change, and my cost of goods sold doesn't change. And from this point, I can just drag it all the way to the last year. Okay, and all my numbers here, as you can see, incorporate inflation. The reason I did not start dragging from the first year is that this formula does not quite incorporate the inflation number. All right, so as I said, it's really the incremental cash flow matters because the profit you're not getting by abandoning the old project is also an opportunity cost. So we have to deduct that from the plan. So the difference between these two is right here. Okay. And then I just drag it all the way. And take my number from the textbook, so this is all right. Okay, let me zoom out. So you also have the new inventory required by the project. So it is based on the cost goods sold right here, 3% of your cost goods sold. So if you want to prepare for the production, you need to hold up inventory of raw materials, and that raw materials in your warehouse has to be 3% of your annual total cost in the raw materials. So let me just apply the percentage here, 3%, and then multiply by the cost goods sold. So that's why I need this number from the first place. And then keep dragging. I'll check my numbers. Okay, and this one, again, it's 3%. Have it locked, multiplied by the cost goods sold, and then just keep dragging. And the increment in inventory, I will use new minus old. Okay, and then drag it all the way. So what happens here is when I do the replacement using a new machine to replace the old, the inventory in the first year actually got reduced. Okay, I only need to maintain 4.09 million pounds of inventory as opposed to a 4.48 million pounds of inventory required by the old project. And then my inventory will increase, will be more compared to the old project. So the numbers are reflected here. Okay, and for the overhead cost, it is the 3.5% given to us. Okay, make sure it's locked. Okay, multiplied by the investment outlay. So the investment outlay is given here. That's 12 million pounds. We'll see 12 million pounds right here, but I can just use the number here. Okay, so keep it locking. Okay, and then drag it all the way. Okay, so that's 0.42 millions of pounds. If you feel tired watching this, let me just hide the whole thing by using the group function. So you see group right here. Okay, then hit button number 1. Then that gives me a better view of it. Okay, the preliminary engineering cost is 0.5 and it's only one-time expense. So let's just leave it here. And then you need to calculate the pre-tax incremental profit. So pre-tax incremental profit will incorporate the um, depreciation, but it does not quite incorporate the change in net working capital. So let me just expand the view here. So it will be the new gross profit minus the old. So that's the incremental cost of gross profit. And then you need to deduct the depreciation. And this is the depreciation occurred on an incremental basis. So, and this new depreciation basically is the new minus the old. You can, and also I have not deducted the overhead cost yet. Also, I need to deduct the preliminary engineering cost. Okay, so this will give me a 0.2 negative, and then I drag it. So this will be my number, and then I will drag it for all the rest of the years. Alrighty. So the textbook has some rounding issues. The number is a little bit different from mine, but I would suggest you just go with my numbers showing up in this spreadsheet because it's more accurate. And then you have this capital expenditure, which happens on a one-time basis. It's at year 0. And then you need to add back depreciation because we are doing a cash flow calculation. If you deduct a depreciation that is not cash, you have to add it back. You need to add the depreciation just to make it equal to the depreciation. Right, this is something you need to add in your final cash flow. Okay, for the inventory, it is a little bit touchy because what really are doing here are cash flows, whereas inventory is a storage concept. Okay, so only the change of inventory that would affect our cash flows. If inventory this year is 4.9, the next year is 4.9. If it does not change, then there's 0 cash flows based on that. Okay, so for the first year, your inventory is negative 0.39. That means you have a liquidated sum of inventory, and that's gonna be some cash flow for you. You should put a positive 0.39 in number here. However, you should compare that from the year before. So from the year before, your inventory was quite constant. There's no change of inventory. But here you have some deduction inventory that caused you to receive some cash. So you need to put the previous level and then minus the current year's change of inventory. All right, so that's going to be your number for the first year. And then if you compare the second year, you will see that your inventory recouped. Not only this 0.39 got recovered, but also inventory increased by 0.19. So your inventory actually jumped by the total of these two absolute numbers. So I just keep dragging it. So this will give me a negative 0.58. So that means my inventory was pretty small at year 1, but at year 2, it got increased. So this is how much the increase of inventory, and I'm spending this much of cash in there. And then in the next year, there's no cash being spent for the change of inventory because the inventory just keep at 0.19. You see, if you look at your new inventory, it is 4.67 all the way. So there's no cash flow generated from the change of inventory. And even you consider the opportunity cost for abandoning the old project could require this much of inventory, which also does not incur any cash flows. The difference between these two is 0.19, and so that's the incremental benefit or cost for this new project, and this inventory does not really change, so there's no cash flow effect. And then I just keep dragging. You see your cost of goods sold for the new project keep changing due to the variable gross margin. Then your new inventory would change, and so the cash flows from the change inventory would be different. in some years, okay? In which years? It will be the first year your gross profit margin change. Recall that on the top of page, you have this different increment of gross profit margin, and that's gonna lead different level of cost of goods sold, different level of inventory required to maintain those cost of goods sold. And that basically would happen in some years, in year 1, in year 6, and also in year 11. Okay, now it's time to consolidate. So I'm going to add the first is capital expenditure. The rest would be easy. We just simply consolidate all the items, but be careful, the incremental operating profit needs to be after tax, okay? So you need to incorporate the tax rate on the top, which is at 30%. Make sure it's locked, okay? Hit enter. And also you need to add back the depreciation and incorporate the cash flow effect from a change of inventory. All right, so that's 1.85, and then you just drag it all the way. So this is your free cash flow. Alrighty, and then you calculate the NPV. It is based on 10% cost of capital. You'll put it right here, comma. You don't need to lock this time. And then you put all the cash flows in the future years from year 1 to year 15 in the NPV parentheses, and then you add this capital expenditure up front. So this is your NPV, and to calculate your IRR is also pretty easy. Just do IRR and then all the cash flows inside the box. Then that's at 24.3%. That's a pretty impressive. And for the payback period, you need to think up to how many years your depreciation, your capital expenditure is paid off. So you really need to get the accumulated cash flow. So it is the sum of all the current year's cash flow and the cash flow in years before. So let me just put it here. Okay, so if it's just by itself, then it's $12 million for the first year. And I really want to lock the first starting number in the sum formula, and then let free of the ending number. So if I just keep dragging, as you will see, my next number is the year 1's cash plus year 0's cash, and then the number after that is the year 2 cash plus year 1, year 0 cash, so on and so forth. Okay, I can drag it all the way down, but I really don't need it because I know that after 1, 2, 3, this is year 0. So after 1, 2, 3, in the 4th year, my cash flow got recouped. So all the negative $12 million investment got paid off. So my number should be 3 years plus a fraction number, and that fraction number would be this the money I made in the 3rd year as a numerator, as a denominator, and the money left at the beginning of the 4th year, okay, will be the numerator. Okay, but I need to put an absolute sign there because I want this to be a positive output. So you will see that this is the ending balance after 3 years, and it is the beginning balance at the beginning of the 4th year, and how much money I make in the 4th year, 3.81. So the fraction is 0.77, so that means I'm going to take roughly 77% of the 4th year's cash to pay off the residual balance after the first 3 years. Okay, so the number should be 3.77. So that concludes this exercise. Although shares outstanding is put here, but we're not doing any calculations regarding to market value and the stock prices. So just to check your answer, and be careful, there are some rounding issues in the textbook, and just to follow my spreadsheet.